Gold and silver are often grouped together under a single label, precious metals. They are priced in dollars per ounce, traded globally, and widely held as stores of value. But in 2026, the similarities largely end there. Beneath the surface, they behave like two distinct asset classes responding to different economic forces. Gold functions primarily as a monetary hedge. Its price behavior reflects shifts in macro uncertainty, currency credibility, real yields, and institutional capital flows. It tends to exhibit lower volatility and more controlled drawdowns, reinforcing its role as portfolio ballast during periods of financial stress. Silver, by contrast, occupies a dual identity. It shares gold's monetary characteristics, but it also operates as an industrial commodity. A significant portion of its demand is tied to manufacturing, electrification, and photovoltaic expansion. That hybrid structure creates asymmetry. In risk-on environments or industrial expansion phases, silver can outperform dramatically. In liquidity shocks, it can fall faster and further. The central question for 2026 is not which metal is superior in absolute terms. It is which one makes more sense given the role an investor expects it to play. The answer depends on understanding how differently these two markets actually function. From the beginning of 2024 through February 19, 2026, the divergence between gold and silver becomes measurable. Using daily XAUUSD and XAGUSD spot price series over this window, the return profile tells a clear story. Gold advanced 27.5% in 2024. In 2025, it gained another 62.5%. By February 19, 2026, it was up an additional 14.6% year to date. Over the full period, the price moved from approximately $2,058.94 per ounce to $4,962.91. Trailing returns reflect this sustained move, with one-year performance near 69% and three-year performance approaching 170%. Silver followed the same directional trend, but with far greater amplitude. It rose 22.2% in 2024, then surged 142.3% in 2025. By February 19, 2026, it was up 5.8% year to date. Across the full window, silver climbed from roughly $23.66 to $76 to $78 per ounce. Trailing three-year performance exceeded 250%. The cost of that acceleration is visible in the risk statistics. Gold's annualized volatility over this period was approximately 20%, with a maximum drawdown near negative 13.9%. Silver's annualized volatility was roughly 42.7%, more than double gold's, and its maximum drawdown reached approximately negative 39.3%. The contrast is straightforward. Gold delivered strong gains with comparatively contained risk. Silver delivered larger cumulative gains, but those gains came with materially higher volatility and significantly deeper interim declines. Price performance alone does not define how an asset behaves inside a portfolio. The interaction between assets, especially during stress, often matters more than headline returns. Over the 2024 to early 2026 window, gold and silver moved together at times, but their statistical relationships reveal important differences. The correlation between daily returns in gold and silver was approximately 0.76. That figure confirms that they are related markets, influenced by overlapping macro forces. However, correlation to equities diverges meaningfully. Gold's correlation to the S&P 500 during this period was roughly 0.10, indicating only a weak relationship with equity market direction. Silver's correlation to equities was higher, around 0.24, suggesting greater sensitivity to broader risk sentiment. This difference becomes more apparent when considering beta dynamics. Silver's estimated beta to gold over the same sample was materially greater than 1, near 1.6. In practical terms, when gold rises, silver tends to rise more. When gold falls, silver tends to decline more sharply. The same leverage effect that amplifies upside during strong metals cycles also intensifies downside during liquidity-driven sell-offs. These relationships help clarify portfolio roles. Gold's lower volatility and weak equity correlation reinforce its function as stabilizer during periods of uncertainty. Silver's higher volatility and stronger linkage to risk assets position it as a cyclical amplifier rather than a pure defensive hedge. One of the simplest ways to compare gold and silver is through the gold to silver ratio. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. It compresses relative performance into a single number and often reflects shifts in macro regime. When the ratio is high, gold is outperforming. That environment typically aligns with monetary stress, growth concerns, or tighter liquidity conditions. When the ratio is low, silver is leading, often during periods characterized by stronger industrial momentum, reflationary expectations, or heightened speculative participation. As of February 19, 2026, the ratio stood near 64.6. Over the previous 5 trading years, its average level was approximately 82.2. The move down to the mid-60s represents a significant compression, roughly 2 standard deviations from that 5-year mean. In practical terms, silver has already delivered substantial relative outperformance. This compression alters the forward-looking calculus. The earlier mean reversion tailwind that supported silver's catch-up phase has largely played out. Going forward, relative performance is likely to depend less on simple valuation adjustment and more on whether industrial demand remains structurally strong and whether investor flows continue to reinforce silver's momentum. In modern precious metals markets, exchange-traded products act as transmission channels between institutional capital and physical supply. Flows into or out of these vehicles can materially influence price dynamics, particularly when underlying markets are tight. Gold provides the clearest example. SPDR's GLD publishes detailed archive data, including bullion holdings in tons. In 2024, holdings began near 878.5 tons and ended the year around 872.5 tons, reflecting a modest net outflow. In 2025, the pattern shifted sharply. Holdings rose from approximately 872.5 tons to 1,070.6 tons, an increase of about 198 tons over the year. By early 2026, holdings remained above 1,000 tons, with more incremental additions bringing totals near 1,075 tons by mid-February. Assets under management rose in parallel, reflecting both price appreciation and inflows. The World Gold Council's reporting reinforces this shift. Its 2025 summary highlights that U.S.-listed gold ETFs added 437 tons during the year, and total gold demand exceeded 5,000 tons for the first time. In 2024, ETF holdings were described as broadly unchanged after multiple years of heavy outflows, signaling stabilization before renewed demand. Silver's exchange-traded flows operate within a different structural backdrop. The World Silver Survey 2025 reports net investment in silver ETPs of roughly 61.6 million ounces in 2024, with a 2025 outlook near 70 million ounces. Unlike gold, these flows enter a market described as running a significant physical deficit. In that context, even moderate investment inflows can amplify price moves more dramatically than in gold's deeper and more liquid market. On the supply side, gold and silver differ not only in scale but also in structural responsiveness. According to the USGS 2026 mineral commodity summaries, global gold mine production was approximately 3,280 tons in 2024 and an estimated 3,300 tons in 2025. World reserves are listed near 66,000 tons. Production is geographically diversified, with major output from countries including China, Australia, and Russia, among others. While diversified, this concentration still leaves the market exposed to policy shifts, sanctions risk, energy constraints, or export restrictions in key jurisdictions. Silver's scale is larger in volume terms. USGS reports global mine production around 25,300 tons in 2024 and roughly 26,000 tons in 2025, with world reserves near 610,000 tons. Major producers include Mexico, China, and Peru, alongside other countries across Latin America and Eurasia. As with gold, geopolitical factors such as permitting, taxation, and social license to operate can influence supply stability. The structural distinction lies in composition. The World Silver Survey 2025 notes that global silver mine production rose approximately 0.9% to 819.7 million ounces in 2024. It also emphasizes silver's dependence on byproduct output from copper and lead zinc systems. That dependence limits silver's ability to respond directly to higher prices. Recycling increased 6% to 193.9 million ounces, a 12-year high. Yet the market still recorded a substantial deficit of roughly 150 million ounces. Gold's supply profile appears steadier. Silver's appears tighter and less elastic. Demand composition further separates these two markets. Gold's demand profile is dominated by monetary and investment channels. The World Gold Council reports that in 2024, total gold demand, including over-the-counter activity, reached approximately 4,974 tons, the highest level on record at that time. Central banks purchased more than 1,000 tons for the third consecutive year, reinforcing official sector accumulation as a structural pillar. Annual investment demand reached about 1,180 tons, up 25% year over year. In 2025, total gold demand exceeded 5,000 tons for the first time. The price registered 53 new all-time highs during the year, and total demand value reached roughly $555 billion US dollars. The narrative around gold remains centered on monetary credibility, reserve diversification, and institutional allocation decisions. Silver's demand engine looks materially different. The World Silver Survey 2025 reports that industrial demand reached a record 680.5 million ounces in 2024, rising 4% year over year. Growth was linked to green economy drivers, including grid infrastructure, vehicle electrification, and photovoltaics. Newly added photovoltaic capacity in China alone reached 278 gigawatts in 2024, reinforcing the scale of this industrial channel. Total silver demand in 2024 was approximately 1,164.1 million ounces, down modestly year over year, yet the market still recorded a significant deficit. Industrial demand represents the largest share of the total mix, giving silver an economic sensitivity that gold does not share. Macro conditions determine which segment of demand dominates at any given time. The World Silver Survey 2025 frames pricing dynamics in 2024 around the end of rate hikes and the expectation of eventual policy easing. It notes that rate cuts materialized in the second half of 2024 and suggests that upcoming U.S. rate cuts could support investor interest, while acknowledging uncertainty around policy clarity. In environments where real yields fall or cuts are anticipated, gold's monetary premium tends to expand. When industrial expansion accelerates, silver gains an additional layer of demand that gold does not possess. The gold-to-silver ratio functions as a concise scoreboard for these regimes. A widening ratio generally aligns with monetary stress and tighter liquidity, favoring gold. A compressing ratio aligns with industrial momentum and reflationary sentiment, favoring silver. With the ratio near 64.6 as of February 19, 2026, significantly below its recent multi-year average near 82, silver has already experienced substantial relative strength. Under a base case in which rate cuts are gradual, growth is mixed, and ETF flows normalize, gold could remain near current levels or modestly higher, while the ratio drifts toward the 70 to 75 range. In that context, illustrative ranges suggest gold between approximately $4,800 and $5,500 per ounce, and silver between roughly $65 and $80. In a bull case characterized by strong electrification investment, persistent structural deficits, and renewed inflows, further ratio compression toward the mid-50s could occur, implying higher ranges for both metals. In a bear case, marked by restrictive policy, a strong US dollar, and ETF outflows, the ratio could widen back toward 80 to 90, with silver underperforming gold. The question of which metal makes more sense in 2026 ultimately depends on the function it is expected to serve within a portfolio. The empirical evidence from the 2024 to early 2026 window highlights a consistent pattern. Gold has delivered strong cumulative returns with materially lower volatility and shallower drawdowns, while silver has provided higher upside accompanied by substantially greater risk. For investors seeking a core allocation designed to hedge policy uncertainty, currency credibility risk, or financial instability, gold's characteristics align more closely with that objective. Its weak correlation to equities, steadier drawdown profile, and sustained central bank demand reinforce its role as a foundational holding within a precious metals allocation. Silver becomes more compelling when the objective shifts towards cyclical participation. Its record industrial demand, structural deficits, and sensitivity to electrification and photovoltaic expansion provide an additional growth-linked channel. In reflationary or risk-on environments, its higher beta to gold and greater responsiveness to investment inflows can amplify returns. That same leverage, however, implies deeper interim declines during liquidity stress. Catalysts further clarify the distinction. Gold tends to respond positively to geopolitical escalation, recession risk, faster than expected rate cuts, renewed US dollar weakness, and continued central bank diversification. Silver responds not only to those forces, but also to surprises in industrial demand, photovoltaic build-out, ETP inflows, and supply disruptions in key producing regions. In 2026, gold appears structurally suited as the core precious metal allocation. Silver appears more appropriate as a tactical satellite, contingent on macro conviction and tolerance for volatility.